This
There we go.
conference will now be recorded.
Now, today we will touch on the latest and greatest, particularly about that $900 billion coronavirus relief deal that's before Congress right now. We will recap the reporting requirements as well as go through the FAQs that have been, well, frequently asked. Uh, and there is a lot to unpack here, so I will be quiet now and hand it over to Mike. Mike?
All right. Thanks, Aaron. All right. Hey, everybody. Merry Christmas. Let's get into this. Flip to the next slide, Aaron. Y'all probably have to be under a rock to not know that Congress worked through the weekend and they have reached agreement on the next $900 billion package, like Aaron was saying. It's my understanding that the final vote hasn't occurred. It's obviously not signed by President Trump yet. And we're still pending, everybody's still pending the full bill, that the details of all the material in there. But you've probably seen what we have seen about the key provisions that are in there. The vaccine funding, I won't read these to you, but 8 billion for distribution, 20 billion for making sure that everybody can get it at no cost, 20 billion to the states for testing and contract tracing. It reloads the Paycheck Protection Program, 284 billion. They spent about 350 billion with the first round. And so all those details of what's going to be in that, if you're one of the independent practices or a below 500 employee hospital that's on the phone, all the details of that you want to ask are not out yet. And so you see what's been published so far, that it's a very similar to the original program, probably in theory clipping off the bigger ones that they didn't want to get it, or the multi-state kind of corporate entities that they didn't want to have access to it in the first place. But it clearly it's there for the smaller business to get a second round of funding. This is not based on the first 8 weeks or the first 8 or 24 weeks. This is an additional loan program for that, and so it would be based off of a new time frame, all of which is not published at this point. And so it includes 20 billion for companies, low income areas, and money set aside for loans for community-based, minority-owned lenders to distribute as well. And so the last thing that came out about it was that it does include a provision to offset, as we've been talking before. IRS notice that came out in November said if you're going to be forgiven, it doesn't matter whether or not you're holding the forgiveness in hand or not, the forgiveness letter from the bank in hand, but those expenses are to be offset and you cannot claim those. This includes a provision that says if there's a reduction of income, quote unquote, that you might be able to offset and allow those take the expenses that are being attributed to PPP and still deduct those as if they're allowable cost on the tax returns. And so that, no details out on that, but that we'll need to track that because that's going to affect a lot of y'all, on the for-profits that are on the phone today that got PPP money the first time. $600 stimulus check, exactly half of the program from last time. $2,400 for a family of 4. It extends the unemployment benefit, $300 through mid-March. There's 15 billion in nutritional assistance and WIC assistance, and then it extends that eviction moratorium for 1 more month and replenish the rent assistance program. Now, what's next slide? What's not in there? 2 or 3 of these things that were covered in the HEROES Act from the Democratic bill that was passed by the House 9 months ago now. There is no reloading of the HHS provider relief funds in this package. So all those funds that you guys have been receiving in pieces and parts over the last several months, the HEROES Act basically piled it back in there and restarted the program over again. That is not included in this stimulus package. There's not a provision for MAP forgiveness in here, the Medicare prepayment program, or tax implication relief. If you are a for-profit, and we've been beating this drum for the last month or two since the IRS ruled on that, if you are holding Medicare prepayment money at 12/31, it is going to be considered to be ordinary income to your practice. And so if you don't want to go through all that, you need to pay it back. Holler at us later on, and we'll send you the information from Palmetto on how to send the money back in. But you're kind of running out of time if you don't want to trigger tax implications for your providers. Now, for the hospitals, it's a non-issue, so not to be worried about from that perspective. What's also not in here is that there was a lot of push, and you know, Senator McConnell had said several times that the intention of the PPP program was for it to be fully, that the expenses were to be fully allowable, and that the loan forgiveness was not to generate ordinary income to practices. And we've gone through that whole game, and you saw from the prior slide what's in theory what's in there. Only if there's an income reduction per se would there be allowability of the offset expenses. And so waiting on the details of that to come out. And then obviously from the House side of the bill, and the big Democratic push has been for the state and local government relief. Now, thus far, state of Georgia has not passed through any of its, you know, economic burden of COVID through to the Medicaid program to cut rates or anything like that per se, at least for the hospitals and practices. The CSBs on the phone have had some impact of that, but nonetheless, that none of that relief that was being pushed for came through in the package this time. Next slide. So just another little more update on other stuff before we get to the reporting requirements again. If you applied for round 3 distributions, the distribution started coming out last week. There's 24.5 billion that was distributed, and as it turned out, it was up to 88% of your reported lost revenue had any of the other rounds not gotten you more relief than that. And so who got it? 70,000 providers received funding that round, including many who had not gotten anything in the prior rounds. And of those who applied, over 35,000 will not get any additional payment, either because they had no loss or because they've already gotten money that was equal to or greater than what they would have gotten under this methodology. And so again, same terms and conditions and the same reporting requirements and all that apply to this round of money. And so if you're a practice that got money last week out of the blue, another one of those HHS payments, or a hospital or a CSB, then this is what it's related to, almost assuredly. And so it falls into the same bucket of what we're going to have to justify in the reporting that we're about to talk about. Next slide. So the key dates have not changed. In theory, the portal is still supposed to open for the reporting of how you have spent the expenses. The HHS portal is supposed to open on January the 15th, and February the 15th, the first reporting deadline is out there for all the funds expended and the lost revenue through 12/31. If that bite at the apple doesn't fully justify the funds that you have received so far, then there is a second bite at it that will come for the activity from January through June 30 of 21 that will be reportable or should be reported by July 31st of 2021. And so none of those dates have changed, you know, but the portal, we were really hoping the portal would open faster than a month ahead of time, but that it hasn't opened, and it doesn't look like the timing of that is going to be adjusted. Will the extensions be available? Yes, there's sort of standard rules around asking for that. You see the websites to go get that. If you have any questions about that, please let us know. Moving to that next slide. All right, this is just the next couple slides are a little bit of background of information that we've kind of beat to death in terms of kind of the format of the HHS reporting. None of that has changed. What we're going to do today is kind of walk through the next round of FAQs that has occurred and kind of give you some more information about what we think has been clarified and what we think has not been clarified thus far. So the basic formula has not changed since it started. That the theory is that it's the PRF that you got, the provider relief funds that you got, minus the general administrative expenses that we'll talk about, and that's salaries and sort of overhead type expenses, and then minus the healthcare expenses related to the coronavirus, i.e. supplies, IT, specific facilities, things that you did that related to the virus itself or the reaction to the virus. And then the last section will be a pretty straightforward year over year revenue comparison, and then any lost revenues that became generated from that. Like I was saying before, the same terms and conditions do apply. Next slide. All right, so in terms of the reporting, I think I had mentioned this before, but I've gotten a few questions from you guys subsequently that they were requiring, the HHS is going to require full reporting on both the expense categories and the capital investments and lost revenue for whatever period of time that you are reporting on. So if everybody's going to report for 2020, and so if you believe that you've fully justified your expenditures off the expense section, doesn't matter. You have to fill out the revenue section of it. When you look into next year, same thing is true. Even if you believe that the first part of it justifies the payment, you still need to fill out the full expense and the revenue side of it. And so everybody that got more than $10,000 is required to go through this process. And then that last bullet point down there, if 2021 is required for you to finish fully justifying the monies received, the question was whether or not you could only use lost revenues for that 6-month period versus being able to justify based on expenses as well. And it is clear in the FAQ that you must report and can claim justification from both the expense side of it and the revenue side of it. So again, if you get to the point of where you have to submit the information for the first 6 months of 21, you can use your expenses, you can use your capital investments as we discussed last time, and then any change of revenue first 6 months of 21 versus the first 6 months of 19. All of that is applicable to use to justify the HHS, the provider relief funds that you have received. Next slide. This is not new information. The same thing, they break the expenses down into general administrative and then healthcare related. And then it is expenses attributable, and we'll talk about this in more detail in just a second, to the virus, not reimbursed by another source, insurance payments or the governmental agencies, FEMA, PPP, all that good stuff. We'll talk about that in just a second. And if you have received more than 500,000 in all of the applicable rounds combined, then you do have to provide more detailed data, and the portal will walk providers through that to get that additional information input. Next slide. All right, getting into kind of the FAQs, this one, a little bit interesting point. So if you're in the position where you're going to have to return some of the money, if you put the money aside, any interest that has accrued on the money up to the point that you have to send it back, they want that too, which is kind of crazy, but it kind of is what it is. You have to show the calculation for it, and then you have to submit that back with any return payments that you make. If you didn't hold it in an interest-bearing account, there's no obligation to return any additional amount. And then they reserve the right to audit in the future to make sure that whatever interest you did earn, that you did return it to them. So there you go. Next slide. No big deal. This will be on the website, but this is the process that if you are in the position to return payments, that's applicable to this page. But also if you're returning the interest accrued related to that as well, then all of, this is the process by which you will remit the payment back to HHS in the first place. I won't get into the details of that right now. Okay, next slide. All right, as it relates to personnel expenses, I'll show you below the couple of clarifications that we've been sort of desperately looking for that we didn't get, but we'll start with what did come through. They answered a question related to definition of allowable personnel expense to determine whether or not hiring bonuses, retention payments, hazard pay, childcare, and temp housing, any of those kinds of things that you had to incur in order to retain staff or be able to get staff in the first place. They did clarify that all of that is clearly an allowable expense or a justified expense in the program now. What the frustration has been are these bottom 2 points. There's a provision in there, as I was saying before, that it's what was not reimbursed from other sources. Well, it appears to include, from our read of it, payments received from insurance and or patients. And our question is, are we supposed to attribute revenue to the various categories of expense and take our revenue and sort of arbitrarily cut it between that? And if all payments received, does that mean that otherwise profitable entity, do you have no includable expenses? There hasn't been an FAQ directly related to that. We are submitting our own FAQ around that, and we'll certainly provide that answer as soon as we get it. But the core thought is that if you're a practice where the providers are, taking some salary, and yet the rest of their profit is reported back to them via K1, if your expenses are already covered by your revenue, does that by definition mean that you have no expenses to claim? And so we'll continue to monitor that, but don't have any clarification on that point. And then from a general administrative perspective, the definition of it does not seem to be described as incremental the same way I was talking about last time. And if you go look at our last PowerPoint, we included the example that HHS had put in their answer to the FAQ that didn't really show a year-over-year calculation. It looked like it was direct salaries minus offset revenues that had come for it. So if it's not, there's one bullet point in the description of it that describes it would be year over year, and yet the example, and there's no other reference to incremental cost. And so we still need a direct answer that personnel costs are not includable only to the extent that they've increased over last year because of that one wording of the increment, the word incremental that was in one of the definitions. So we'll pose that question as well, but don't have that answer just yet. Next slide. In terms of outsourced vendor expenses, it's pretty clear that that outsourced expenses are intended to be allowable, similarly to salary. Services that were enabled sustained access to healthcare services, daily operations. You see the categories there, nutritional services, facilities, laundering, those kinds of things are clearly includable expenses. It does say, quote unquote, if they are attributable to coronavirus, which, in the context of food services, for example, not 100% sure what that would mean. And there's not an additional definition related to that. And it could be referring to that we're supposed to do some sort of allocation based on percentage of meals, percentage of COVID patients, something like that. But that's not clarified at this point in the FAQ one way or the other. So unfortunately, more to come related to that. The next one is potentially a really big deal to the for-profit entities on the phone. The question was, are the taxes imposed on provider relief funds, are they allowable expenses in the first place? And the answer is generally yes. However, most of the practice, if you're a nonprofit hospital or a CSB on the phone, this point just doesn't relate to you. If you're one of our independent practices on the phone, typically you're an LLC or an S Corp. The clarifying question that we need to pose around this is it appears that the intention is to allow the whoever's actually paying tax on it to have that tax payment offset some of the PRF funds. However, if you're an S Corp or an LLC that doesn't pay tax yourself and it's a K1 that's coming through to the provider, and you're paying tax on it at that level, then it seems to imply that a C corp that pays tax directly is okay, and that we need to clarify LLC S corp. Otherwise, you know, if we can get that clarified, then that's going to be a pretty big deal. It does imply though that your tax accountants are going to have to do a with and without version of the taxes and claim the difference, which is a little bit of incremental work that's going to have to be done on that side. Next slide. In terms of kind of drilling down a little bit more into the calculation of expenses attributable to the virus and not reimbursed by other sources, they sort of parroted back the original definition that it's that second bullet point there, that it's the amounts from other sources do include direct patient billing, commercial insurance reimbursement, Medicare, Medicaid, and then get into the governmental stuff like FEMA, the COVID-19, the PRF money directly related to COVID-19 uninsured, PPP program. All those things are clear that they would have to offset. My still standard question is about the reimbursement that came from the insurance. If that is fully to be included, I think a lot of the physician practices are gonna have a problem. That's sort of inherently unfair. And I think, well, not only the practices, the if you're a profitable CSB or nonprofit hospital on the phone, and your insurance and direct patient payments are covering your expenses, I think it begs the question whether or not you have any includable expenses or not, and we need to get that clarified, absolutely, for sure. The next slide, the intention, I think it was an FAQ, again, related to trying to give a little bit more clarity on how the non-G&A expenses should be generating justifiable cost to justify the PRF funds that have received. And this example was in there before, but basically the point is, or the clarification is, and let's go down to that last bullet. It appears to be an attempt to account for a situation where the expenses of the provider are similar year over year, but because of the pandemic, you've had lower volume, such that when you convert to a cost per visit or a cost per episode, if, you know, depending on the type of provider you are, that would show an increased expense. Thus, you could use that increased cost per visit for the healthcare expenses related to the coronavirus, which is the non-G&A stuff, administrative general stuff. It's their attempt to convert that to a per visit in order to give you another angle to try to justify the expense from. Now, granted, this goes the other way as well. If for some reason your volume went up and your per visit cost dropped, that's going to be harmful. But I think the intention is to allow where you maintain staff, you have some increment of COVID type expenses, but basically the costs were in line / a little bit up, that converting it to a per visit gives you an ability to claim more expense than you would have otherwise. And I think that's the intention of that. Next slide. There were a couple of questions related to the allowability of the cost for distribution of the vaccine or the cost of the vaccine itself. And I think it's clear that the intention is to cover those kind of expenses, that not just the cost of the vaccine itself, to the degree it's not reimbursed otherwise by the insurance company itself, but that it does include reimbursement for funds for that last sentence of the first bullet. Additional refrigerators, personnel costs to provide the vaccination, transportation costs, all those kinds of things not otherwise reimbursed, that the intention is to pay for that. And so those would be includable justifying expenses. And then that other one down there, the other question, what about doses admin for Medicare, Medicaid, CHIP beneficiaries? And to the degree that kind of reimbursement doesn't cover the full expense of administering the drug, cost of the drug and then the other types of surrounding costs to it, that the PRF funds may be used to cover the remaining cost, and let that be part of the justification. Next slide. If you are a single tax ID number providing, this is probably obvious to most of y'all on the phone, like the CSBs, you guys are typically a single tax ID number, provide services in 20 different locations. The clear implication here is that the idea is that you would be reporting on the culmination of all of that across all of the physical locations. And so everything this is the tax ID number oriented reporting mechanism, not a location oriented reporting. So that's pretty straightforward. Next slide. Wasn't really expecting this. Should providers include fundraising revenues, grants, donations when determining patient care revenue? And oddly enough, the answer is yes. Such that it's as I told you before, it's the lost revenue calculation is 2020 full year revenue minus 2019 full year revenue. And this is clarifying that basically fundraising, revenues, grants, other kinds of donations that have come to the organization year over year, those are to be included in both 20 and 19. So in theory, if fundraising is up over 19, it's going to offset some of the lost revenue. If it's down, obviously, it will contribute to it because it's just another revenue that's going to be included as if it's part of patient care revenue, which I really wasn't expecting, but the answer is pretty straightforward. Yes, we are to include that in the mix. Shifting over to the next slide. Kind of our summation. I showed you this slide before, and it's a little bit updated. And actually, one of the questions came off because it's clearly already been covered in what I've talked about. Our clear issues have been whether or not fully the other reimbursement is to offset all those expenses. No, you see my bullet point there. No update. It still appears to require offset for insurance patient collections, but maybe I'm just in a denial because it doesn't seem like that's fair, but that's still leaning in the bad direction, and no update from the FAQs on that. The next one, salaries, benefits. This is the phrase I was talking about before, that only the incremental unreimbursed amounts, and yet it's not in the expense. It's not in their calculation like that. It's not in the example like that. And so, but there was no direct question related to it. And so, again, we're going to pose our own question and kind of see if we can get an answer to directly hit at that. And then my last little Johnny one note on if we're reporting eligible expenses, how do we have anything to report if the entity has a profit? And so there was not a direct question related to that one either. So we'll pose our own question there. On this next one here, there are two main questions were still related to if you have change of services, change of providers, or what have you. Is there any implication in the calculation for that? And there's no clarification. It just seems like those kinds of things are not going to impact the calculation one way or the other, which again, as I've told you before, it certainly harms those of you who had added a new provider, added a new service just before the pandemic, and you were trending revenues up. And when you went through COVID and it trended it back down, if it didn't trend it below last year, then yes, you've had a negative revenue impact of COVID, but you're not going to get to claim it because it's still more than 2019. And so again, it seems sort of inherently unfair for those of you in that position, but I'm not expecting a clarification at this point. It just seems like that's the way it's going to be. And then same thing as I was saying before, and there's no clarification, but I think the answer is still clear that if one part of the organization was way down and another part of the organization was up so much, emergency room versus radiology kind of stuff, that can one area be claimed that is most hit and remove the increment that's coming from another area growing at the same time? And it just doesn't seem like there's going to be any provision for that one way or the other. It's lost, it's revenue in 20 minus revenue in 19. That's kind of it to the calculation. Next slide. Again, this is mostly, this is not for the CSBs and the nonprofit hospitals. This is just kind of a reminder that for the practices that the IRS had already ruled back in November that regardless of whether or not your forgiveness letter is back from the bank and, SBC approved, all that kind of stuff, that if you could reasonably expect that loan to be forgiven for the PPP program, that you couldn't claim the expenses one way or the other. And so the game we were trying to play about, slow walk the forgiveness process, not applicable post that ruling coming out. As I said before, though, that last bullet point, the update is that no details yet, but if you saw a reduction in revenue year over year, then either to a certain extent or maybe overall that those expenses might be deductible. But we'll report on that when we can. And then I believe the last slide. This got clarified a while back, but we still get a lot of questions about it. For those of you who are going through the PPP forgiveness program and you've got an EIDL, that $10,000 grant way back when, what they've ruled is that has to be offset against the forgiveness, which means it kind of just turned the EIDL advance into a loan. And so if you're like us, our PPP forgiveness would be out there, but we did get a grant, and so we owe back $10,000. And so that's pretty clear, and it came out a couple of months ago, and probably should have reported on it then, but that's just to clarify it. I think it's still an issue out there to be clarified because, you guys, we were still getting a lot of questions on it. I think that's it for the slides. I think there's a question. Oh, okay. If anybody has any questions, then feel free to unmute and ask them. That was pretty quick. Aaron, did you see? Yep.
This is Kelly. I did just want to say that we know it's going to be a really short time frame once we get back for January. The portal goes live. So what we're currently planning on, what you guys should see from us in the next week or so, is we'll reconvene on a forum, looks like on January 20th, and then we'll be setting up some individual provider workshops, because we'll have basically 30 days from when the HHS reporting portal opens to when the first report is going to be due. So look for that coming from us in the next week or so.
And on 120, I think that we will devote the entire time. As soon as the portal comes out, we're going to have to kind of dissect it to get at the answers to some of the questions and stuff. And then we'll report that back on that day. Any more questions for today?
Yes, I wasn't able to log in on time, and I was wondering, is there any place where I can go and see if it was recorded, that I can watch the recorded one?
Yeah, Aaron will post it on our website, and he can show you where that link is.
Okay.
Yeah, we will be posting the recording as well as a copy of today's slides on our website, which is shpllc.com/webinars.
Okay, SHP.
Yeah, it should be up this afternoon.
Oh, I appreciate it. Thank you.
Yeah, I did get one more question. If the Medicare prepayments are held and paid back in 2021, will the amount paid back be deductible from revenue in 2021? The answer is yes. It will just serve as, it'll be just a straight reduction of revenue at whatever point that you choose to pay it back. It's more like how a payment and a take back from the insurance company occurs. Like they make a payment to you and then come back along 6 months later on and take it back from you. From a tax perspective, it's ordinary income to your providers in the year you got that payment, and that it's a reduction of ordinary income in the year they took their money back. It's exactly like that, and that's why the IRS ruled the way it did. If Medicare had formed this as a loan to providers, it wouldn't have generated tax implication, but they didn't. It was always a prepayment of services and a recoupment of those prepayments in, you know, whatever period of time they did it for later on. Again, none of that is an issue to the CSBs and the nonprofit hospitals that are on the phone. Any other questions? Good deal. Well, we appreciate your time yet again. Thank y'all for hopping on. Aaron, you want to wrap us up?
Alrighty, well, thank you everybody for attending today. Again, we will be posting this to our website at shp.com, or sorry, shpllc.com/webinars. Hope everybody has a very Merry Christmas, and keep a lookout on your inbox for upcoming webinars and meetings. And always, if you do have further questions, feel free to reach out to us, either drop us a line via email or give us a call. Thank you and have a wonderful day.
Thank y'all.